Hey everyone, and welcome. Today, let's pull back the curtain on insurance. Forget all the confusing jargon and the fine print for just a minute, because at its heart, insurance is one of the most powerful and honestly fundamental tools you have for building a truly secure financial life. It's not just some policy you buy, it's your personal financial safety net.
Okay, so here's our game plan. We're going to start with the why, the big, unpredictable shocks that insurance is designed to handle. Then we'll get into the simple but brilliant idea of how it all actually works. After that, we'll cover the 2 rules that make the whole system trustworthy. Then comes the big one. How do you figure out how much you need? And finally, we'll wrap up by looking at how you choose the right kind of protection.
So let's get right to it. What is the #1 reason insurance even exists? Well, it's not really about protecting your car or your house. It's about protecting your single most valuable asset, your ability to earn an income. Seriously, think of your income as the engine of your entire financial life. Insurance is what keeps that engine safe from all the unexpected things that could cause it to just suddenly shut down.
Just pause on that for a second. What would actually happen if, for whatever reason, your ability to earn money was just gone? Poof, vanished overnight. It's a pretty tough question to think about, I know, but it's the exact question that insurance was created to answer.
And look, these aren't just abstract fears, right? These are things that happen to real people. You've got Siddish's family, who suddenly lose their main provider. Or think about Manohar, an architect, whose entire career is just over after a stroke. And then there's Arushi, a talented designer who can't work after an accident. Or even Jayan, who gets hit with a huge financial loss at the worst possible time. In every single one of these cases, a life that was carefully built gets thrown into complete chaos by one single, unpredictable event.
Okay, so with all these scary possibilities out there, what can we actually do about it? Well, the solution is an idea that is both incredibly simple and frankly, remarkably powerful. And that's the whole concept of insurance. It's basically a way for a community, a group of people, to manage the risks that any one person faces alone.
At its core, insurance is all about one thing: risk transfer. It works like this. You, the person getting insured, pay a small, predictable fee, that's the premium, to an insurance company. In return for that small fee, the company agrees to take on the massive financial burden if something bad happens. So you're swapping a potentially devastating, life-ruining financial hit for a small, manageable, regular payment. It's a pretty amazing trade-off when you think about it.
Now, this slide is just a brilliant way to visualize how it all works. Imagine you have 100 merchants. Each one has a ship worth 10 lakh rupees, and they're all terrified of it sinking. Now, they know from experience that, on average, 2 ships sink every month. So instead of each merchant living with that massive risk all by themselves, they do something smart. They all chip in. Each of the 100 merchants pays 20,000 rupees into a shared fund. That creates a pool of 20 lakh rupees, which is exactly enough to completely cover the losses for the 2 unlucky merchants whose ships go down. That right there, that is the magic of insurance. A small, certain cost protects everyone from a huge, uncertain disaster.
Now, for a system like this to work, for everybody to trust each other, it has to be built on a solid foundation. And that foundation is made up of 2 fundamental principles that govern the whole relationship between you and the insurance company. They're like the essential pillars holding the whole thing up. Okay, first up is utmost good faith. It sounds kind of fancy, but all it means is you have a duty to be completely honest when you apply. You have to tell them everything that's relevant, your health, your habits, you name it. Hiding something can get your policy canceled right when your family needs it most. The second rule is insurable interest. This one's simple. You can only insure something if you'd suffer a real financial loss if it was gone. You can insure your own car, of course, but you can't take out a policy on your neighbor's car, because if they crash it, it doesn't hurt you financially.
And this brings us to a super important point. Honesty is everything here. You know, it might be tempting to leave out a small detail to try and get a lower premium, but that is a massive, massive gamble. Trust me, it is so much better to just disclose everything, maybe pay a slightly higher premium, and have total peace of mind that the policy will actually work when it's supposed to.
All right, so we get why we need it, and we get how it works. But that brings us to the biggest, most practical question of all. How much insurance do I actually need? And this isn't about plucking a number out of thin air. There are actually really smart ways to figure this out.
And really, there are 2 main angles we can take here. The first way tries to replace the total economic value you bring to the table. It's called the human life value approach. The second way, which is often a lot more practical, is called the needs-based approach, and it focuses on calculating exactly what your family would need to carry on. So that first method is called the Human Life Value, or HLV. And listen, don't get bogged down by the formula you see on the screen, okay? The core idea is actually pretty simple. It tries to figure out the total value of all the income you would have earned from now until you retire, and then it brings that value back to today's money. It's kind of like a big picture view of your financial worth over your lifetime.
Now, the second method, the needs-based approach, is usually a lot more hands-on and practical. So instead of looking at your future income like the HLV does, this one focuses on your family's future expenses. It adds up everything they'll need for daily life, for big goals, and to pay off any debts like a home loan. It's less about your abstract value and more about their concrete, real-world needs.
And boom, here's what it all boils down to. After you run the numbers using that needs-based approach, you figure out all the future expenses, you add in the loans, and then you subtract whatever savings and investments you already have, you get a specific target. In this case, the gap, the amount of insurance you need to buy, is just over 2 crore rupees. This turns a vague, scary question into a clear, manageable financial goal.
Okay, let's bring this all home in our final section. Once you know how much coverage you need, the next logical step is picking the right tool for the job. Choosing the right type of insurance to get that protection in place.
I absolutely love this analogy. Think of a professional cricketer. They wear all that protective gear, right? Not because it helps them score more runs, but because it prevents one bad ball from ending their entire career. Insurance is your financial protective gear. You have to put it on before you start trying to score runs with your investments. Because one bad hit, one unexpected life event can wipe you out completely. Protection always comes before investment.
So what's the most efficient protective gear out there? Well, for most people, the answer is term insurance. It's the simplest, purest form of life insurance you can get. It's simple. You pay a premium for a set number of years, the term. If you pass away during that term, your family gets the money. If you don't, fantastic. The policy just ends. There are no bells, no whistles, no savings component. It's pure protection, which is exactly why it gives you the most coverage for the lowest possible cost.
And wow, this comparison tells you everything you need to know. Just look at this. To get 1 crore of pure protection with a term insurance plan, it costs about 9,400 rupees a year. Now, for the exact same amount of death benefit from an endowment policy, which tries to mix in some savings, you're paying over 3 lakh rupees a year. The difference is staggering. If your main goal is just protection, term insurance is, without a doubt, the most cost-effective way to get it.
So this brings us back to that big question, should you mix your insurance and your investments? Well, the numbers pretty clearly suggest it's way more efficient to keep them separate. Even with these plans that promise a return of premium, if you actually calculate the return you're getting on that extra money you're paying, it's often just 4 or 5%. The smarter move is usually to buy a cheap, simple term plan and then invest the huge amount of money you've saved somewhere it can actually grow.
So, at the end of the day, it really comes down to this. Take a hard look at your own financial plan. Is it actually protected against the unexpected? Or are you stepping up to bat just hoping for the best, but without any of your protective gear on? The choice, and the incredible peace of mind that comes with it, is completely up to you.